Liquidity disappears faster than confidence, and small financial mistakes compound longer than most people realize. The decisions that keep you broke are rarely dramatic. They are usually ordinary, socially accepted, and repeated so often that they stop feeling like decisions at all. So if you want to stop being financially stuck, you do not start by looking for a miracle investment or a higher risk shortcut. You start by identifying the invisible choices that keep converting your income into fragility instead of capital. Let's be precise. The money decisions that keep you broke usually come from one underlying error. You keep making short-term choices that damage long-term optionality. You commit future income before it arrives. You confuse access to money with ownership of money. You treat every increase in cash flow as permission to increase your standard of living instead of your financial resilience. And then you wonder why you are always working, always earning, always paying, and never truly gaining ground. Here is the operating mechanism behind that. Financial life works like a balance sheet ecosystem. Income enters, expenses remove liquidity, debt introduces fixed pressure, and whatever remains becomes either retained capital or lost opportunity. The market then sits on top of that personal system and amplifies the consequences. If you have liquidity, controlled obligations, and time, volatility can become an advantage because lower prices improve future expected returns. If you are overextended, then the same volatility becomes a threat because it forces you to sell, pause contributions, or borrow at the wrong moment. That is how the market operates in real life for ordinary investors. It does not reward the story you tell about your goals. It reacts to your structure. The financial equivalent of a biological mechanism is stress response. When an organism is healthy, pressure produces adaptation. When it is weak, pressure produces breakdown. Money works the same way. Interest rates, liquidity conditions, cash flow stability, volatility, and crowd positioning all act like environmental pressures. When rates are low and liquidity is abundant, bad financial habits can survive longer than they should because assets rise, credit is accessible, and mistakes feel painless. When liquidity tightens and volatility rises, those same habits become expensive very quickly. A weak cash position becomes a forced sale. A high fixed cost lifestyle becomes a trap. A large speculative position becomes a wound. That is why these money decisions matter. They do not just hurt when life is calm. They become destructive when conditions change. Most people misunderstand this because they look at outcomes without studying structure. They see someone with a nice car, an upgraded apartment, and frequent spending, and they assume progress. They see a rising portfolio and assume intelligence. They see a salary increase and assume safety. But the market and your balance sheet do not care about appearances. They care about cash flow, liquidity, duration, and risk concentration. If your life requires continuous, perfect conditions to remain stable, you are not financially successful. You are financially exposed. So let's talk about the decisions. One of the biggest is lifestyle inflation disguised as self-reward. You get a raise, and instead of raising your savings rate, you raise your monthly obligations. The apartment gets larger, the payment gets heavier, the subscriptions multiply, the travel gets normalized, and the emotional logic sounds reasonable because each increase feels manageable in isolation. But what you are actually doing is reducing the gap between what you earn and what you keep. That gap is where wealth is built. Once you compress it, you force your future self to work harder just to stand still. Another invisible decision that keeps you broke is treating cash reserves like idle money instead of strategic capital. You look at cash and think it is underperforming. You compare it to higher return assets and feel impatient. So you minimize reserves, stay nearly fully deployed, and tell yourself you are being efficient. But efficiency without resilience is fragility. Cash is not there to impress your return calculation. It is there to prevent forced selling, bad borrowing, and panic decisions. It is there to buy you time. And time is one of the most valuable assets in finance because time allows good assets to recover. income to stabilize, and better opportunities to appear. Then there is the decision to mistake activity for progress. A lot of people stay broke because they are financially busy. They are always optimizing something small, always researching something exciting, always reacting to headlines, always making tiny moves that feel intelligent. But busy is not the same as effective. If your savings rate is weak, your fixed obligations are high, and your capital allocation is inconsistent, no amount of financial busyness will save you. Real progress usually looks less exciting. It looks like automated saving, controlled spending, measured position sizing, and a refusal to interrupt compounding. You also stay broke when you make decisions without assigning them a time frame. That mistake is everywhere. You invest short-term money in long-term assets and call it patience until you need the money early. You judge long-term investments based on short-term price action and call it prudence when you exit too soon. You take tactical positions with no exit logic and call it conviction when they drift against you. Time frame confusion is one of the most expensive habits in personal finance because it creates category errors. And category errors feel harmless right up until they are expensive. Now let's apply this in real life. Suppose your income rises by 15%. The broke decision is immediate lifestyle expansion. You upgrade recurring expenses because the new income makes them feel affordable. The better decision is to redirect most of that increase into savings, debt reduction, reserves, or long-term investment contributions before your spending adapts. You force the new cash flow to strengthen your structure before it improves your comfort. That single habit changes the trajectory of your finances because it turns income growth into capital growth instead of expense growth. Suppose the market rallies hard for several months and everyone around you starts acting like risk has disappeared. The broke decision is to chase late, increase position size because recent gains feel like proof, and neglect liquidity because optimism makes cash feel wasteful. The correct response is narrower and calmer. You check whether your current asset allocation has drifted away from target. You assess whether valuations are expanding faster than fundamentals. You keep contributions going if they fit your plan, but you do not suddenly behave like a bull market has eliminated risk. If a single position has grown too large, you rebalance. If speculative ideas are attracting you, you limit size so one wrong decision cannot damage your year. Suppose the market drops 20% and headlines turn negative. The broke decision is to panic, liquidate productive assets to create safety, and tell yourself you will get back in when things look clearer. That usually means selling low and buying back higher, or never re-entering with conviction. The better decision depends on your personal structure. If your emergency fund is intact, your income is stable, and your investment horizon is long, you respond by reviewing rather than reacting. You ask whether the drop is driven by valuation compression, liquidity stress, earnings deterioration, or some mix of all three. If your thesis remains intact and your allocation is long-term, you continue contributions and possibly rebalance. If your liquidity is weak, then you acknowledge the deeper problem is not the market. It is the weakness in your own foundation. You repair that first. Suppose you are carrying high-interest debt while also trying to build a portfolio. Here again, people get confused because investing feels like progress and debt repayment feels boring. But debt changes your required return. If you are paying high interest, then eliminating that debt can be one of the best risk-adjusted uses of capital available to you. You do not build wealth by pretending both sides of the balance sheet are unrelated. They are connected. A dollar of retained capital is more powerful when it is not already claimed by expensive obligations. This is also where position size becomes personal, not theoretical. Too many people think the right investment idea excuses the wrong size. It does not. If you are financially fragile, even a reasonable investment can become dangerous when sized badly. If one position can materially harm your liquidity, your emotional stability, or your ability to continue investing, it is too large. It does not matter how confident you feel. Confidence is not risk control. Position size is risk control. And then there is the decision to outsource judgment to consensus. This keeps people broke in subtle ways because it replaces process with imitation. You copy what appears to be working for someone else without checking whether the conditions match your own life. They may have higher reserves, lower obligations, more stable income, better tax structure, and a longer time horizon. You may only be copying the visible layer. When the environment changes, their strategy may still be manageable for them and destructive for you. That is why financial decisions have to be built from your own balance sheet outward, not from someone else's lifestyle inward. This is where most people stop, but this is the advanced level. Once you understand the obvious mistakes, you need to see the second-order effects that make them dangerous. A bad money decision is not only bad because of its direct cost. It is bad because of what it removes from your future. A higher car payment does not just cost you the monthly difference. It reduces your savings rate, lowers your liquidity growth, increases your required income, raises your break-even point, weakens your ability to tolerate market stress, and narrows the range of opportunities you can act on. That is a second-order chain. Smart financial operators think in chains, not isolated moments. The same applies to market behavior. A rate hike is not just a policy change. It affects mortgage demand, refinancing ability, discount rates, startup funding, credit spreads, and the valuation of long-duration assets. If you are overcommitted to expenses when rates rise, you get squeezed from both sides. Your living costs or financing costs rise, while asset prices may become more volatile. Correlation breakdown matters too. In normal periods, people think their portfolio is diversified because it contains several assets. In stress regimes, those assets can suddenly move together because liquidity and fear dominate. If your entire plan depended on diversification behaving perfectly while your cash reserves stayed thin, that was not a plan. That was an assumption. You also need to understand liquidity traps and bankruptcy mathematics. A falling asset can look cheaper while becoming riskier. If liquidity dries up and forced sellers enter, lower price is not necessarily better value. It may be a warning that the market's problem is not temporary sentiment, but structural pressure. And if you are leveraged, or if your obligations are too high relative to cash flow, your margin for error becomes brutally small. A 50% drawdown needs a 100% gain to recover. That is not emotion. That is arithmetic. The same asymmetry applies in personal finance. A bad financial year often requires several good years to repair. That is why unnoticed money decisions are so dangerous. They do not just waste money, they damage recovery capacity. Behavioral traps sit inside all of this. Overconfidence makes you think concentration equals intelligence. Chasing trends makes you buy after risk has already expanded. Poor risk control makes one mistake large enough to erase months of discipline. Ignoring timeframes makes you hold the wrong asset for the wrong reason at the wrong stage of your life. These are not personality flaws. They are process failures. And once you start treating them as process failures, you can fix them. So how do you practice better decisions? You begin with a written process. Every significant money decision gets a purpose, a time frame, a size, and a risk limit. If you take on a new recurring expense, write down what it does to your savings rate. If you make an investment, write down the reason, the intended holding period, the maximum position size, and what would change your view. If you are tempted to increase lifestyle costs after an income boost, calculate the annualized drag and the opportunity cost of not investing that difference. When you see the math clearly, the decision stops feeling abstract. Then build a checklist. Before any meaningful financial move, you ask, does this improve or weaken my liquidity, my optionality, my savings rate, and my future flexibility? Am I making this decision because it fits my plan or because current conditions make it feel easy? What happens if my income drops? What happens if markets fall? What happens if interest rates stay higher than expected? What happens if I am wrong about timing? That is reverse testing. You are not trying to become pessimistic. You are trying to become durable. Use simulation as well. Run your finances through stress. What happens if your largest monthly expense rises? What happens if your portfolio falls 30%? What happens if your job becomes unstable for 6 months? What happens if two assets you assumed would offset each other fall together? These tests reveal whether your current decisions are building resilience or quietly consuming it. Most people do not discover weakness until reality discovers it for them. You want to reverse that order. To maintain the skill, you need evaluation loops. Review your cash flow monthly, not casually. Review your asset allocation quarterly. Review your fixed cost creep every 90 days. Track metrics that matter: savings rate, months of liquidity, debt service as a percentage of income, portfolio concentration, and the number of non-essential recurring expenses you have allowed to become normal. If you make a mistake, do not just record the cost, record the mechanism. Were you too early, too large, too emotional, too dependent on stable conditions, too impressed by recent returns, or too vague about time horizon? That is where the useful lesson lives. Combine this discipline with broader tools. Use valuation so you understand what price implies. Use macroeconomics so you understand the environment acting on that price. Use technical analysis so you can observe how positioning and behavior are unfolding in real time. Use risk management so even a good idea cannot harm you through bad execution. None of these tools replaces the others. Valuation without macro can keep you trapped in cheap assets that stay cheap for valid reasons. Macro without technicals can make you early and ineffective. Technicals without risk management can turn pattern recognition into reckless trading. Risk management without a real thesis can keep you safe but stagnant. Integration is what turns information into decisions. Then test yourself under pressure. Use paper trades for tactical ideas before using real money. Use small-scale positions when you want emotional realism without severe downside. Do pre-trade risk analysis before every non-routine allocation. Stress test your personal budget when the world feels calm, not when the emergency has already arrived. The goal is not to become perfect. The goal is to become structured enough that stressful conditions do not rewrite your decisions in real time. So when you ask which money decisions keep you broke without you noticing, the answer is clear. They are the choices that weaken liquidity, inflate fixed costs, blur timeframes, oversize risk, outsource judgment, and treat progress as visible spending instead of retained capital. They feel harmless because they are common. They feel justified because they are gradual, and they become dangerous because they quietly turn future opportunity into present comfort. There is one detail here that is easy to miss, and it is the detail worth revisiting. Most bad money decisions do not announce themselves as losses. They first appear as reduced flexibility. And by the time reduced flexibility turns into visible financial stress, the real damage was already done months or years earlier. That is the logic underneath the whole script. If you catch that detail, you stop asking only, "Can I afford this now?" and start asking the question that actually builds wealth. What does this decision do to my future range of choices?